Hello everyone, this is Jatin from gladtutor.com, and today we are going to talk about the dividend policy in financial management, which includes its meaning, types, theories and factor affecting dividend policy. So this is the part 9 of our financial management series. To watch our previous video about the capital structure in financial management, or to watch our complete financial management playlist, click on the upper I button. And if you are a new user, then make sure you subscribe to our channel, so that in future if we upload any video regarding financial management or any other management subject, you will be notified. So let's without wasting so much time, let's get started. So, firstly, we will talk about the meaning of dividend policy. So, before what I believe that before coming to dividend policy, everyone should know what is the meaning of dividend, right? So, dividend refers to the part of the profit made by the company which is distributed among its existing shareholders. So, shareholders get a reward in the form of dividend because they have invested their money into the company, right? On the other hand, companies need to provide funds to finance its long term growth, and for those funds, shareholders invest their money. And if a company pay out a dividend of mostly what it earns, for the further expansion, they have to depend upon their issuing new shares or debenture. Shares or debenture. So, firstly, we are clear about the meaning, right? Debentures are the part of the profit made by the company which is distributed among its existing shareholders. Now come to the dividend policy. Like if a company pays out of the dividend of mostly what it earns, then for the further expansion or the future, company has to depend upon the external debts, or they have to depend upon issuing the new shares. So the dividend policy of a firm affects both the long-term financing and the wealth of shareholders. So as a result, firm decision to pay dividend should be in a manner so that it should equally apportionate the distributed profits and also the retained earnings. So the dividend policy should be in a balanced manner, right? So that it should not affect both company or the shareholders. So I think the meaning of dividend policy is now clear. Now come to the types of dividend policy in financial management. So there are basically three types of dividend policy. First one is regular dividend policy, second one is stable dividend policy, and third one is residual dividend policy. So firstly we will talk about the regular dividend policy. So the regular dividend policy is the payment of dividend at a usual rate is known as the regular dividend policy. The investors such as the widows, retired persons, or any other economical weaker sections, they prefer the regular dividend. So in this regular dividend, company pays a fixed percentage of money or earning as a dividend every year. So now come to the advantages of regular dividend policy. So there are a few advantages of regular dividend policy. First one is it establishes a profitable record of the company. Company has a record that how much they are paying, how much profit they are earning, how much money they are giving to shareholders. It creates the confidence among the shareholders. Yes, obviously if shareholders get the money every year as a dividend, their confidence also increases. In future they can invest more money. It aids in long term financing and renders financing easier. Yes, obvious. It stabilizes the market value of share. Yeah, if you are paying your shareholders well, then the market value of share also increases. The ordinary shareholders view dividend as a source of funds to meet their day-to-day living expenses, and if the profits are not distributed regularly and are retained, the shareholders may have to pay a higher rate of tax in the year when the accumulated profits are distributed. So for example, in 1 year the company doesn't get profit and they didn't pay the dividend. So then year when they pay the accumulated dividends, so on that time the shareholders have to pay a higher rate of tax, right? So these are the advantages of regular dividend policy, financial management. Now come to the stable dividend policy. The term stability of dividend means the consistency in the stream of dividend payments. In more precise terms, or in simple words, it means the payment of certain minimum amount of dividend regularly. The firm will pay the certain minimum amount of dividend on a periodically basis. Whether on this stable dividend policy case, whether the company is earning profit or not, they will receive a dividend. But in the regular dividend policy, it is mandated that the company should earn profit. So there are different forms of stable dividend policy. It can be done through constant dividend per share, constant payout ratio, or stable rupee dividend plus extra dividend. So let's talk about each in detail. So in constant dividend per share, companies follow a policy of paying a fixed dividend per share, irrespective of level of the earnings, right? So for such firms, they usually create the reserve, special reserve for the dividend equalization, so that they can enable their fixed dividend every year for the shareholders, whether they are not get income or not. Constant payout ratio. Constant payout ratio means a payment of fixed percentage of net earnings of a dividend every year, right? The amount of dividend in such a policy fluctuates in direct proportion to the earnings of the company. So in this also they do a fixed amount of net earnings every year. Stable rupee dividend plus extra dividend. In this type of stable dividend policy, companies follow a policy of paying a constant low dividend plus a extra dividend in the year of higher profit. So what they do, they usually pay a constant low dividend per, but in a case if a company earns high profits, they will give them a surplus of extra dividend. So this policy is most suitable for the firms which have a fluctuating earnings from year to year. Now come to the third type of dividend policy, which is residual dividend policy. Residual dividend policy is a highly flexible or volatile, but some investors see it as the only acceptable dividend policy. So in this policy, the companies pay out what dividends remains after paying their capital expenditure, capex, and working capital. What they left, they distribute them as a dividend. So these are about the types of dividend policy in financial management. Now come to the theories of dividend policy in financial management. So there are basically two theories of dividend policy. First one is theory of irrelevance and theory of relevance. Theory of irrelevance comprises of two approaches: residual approach and M&M approach. That is Modigliani and Miller approach. Theory of relevance comprises Volter approach and Jordan approach. So without waiting, now talk about each approach in detail. Theory of irrelevance in residual approach. According to this approach, the dividend decision has no effect on the value of firm or a price of shares, right? So the decision to pay the dividend or retain the earnings may be taken as a residual decisions, but this theory assumes that there is no difference between retaining your money or paying that money as a dividend to the shareholders. So according to this approach, whether companies give dividend or not, it doesn't affect the value of firm or their share price, right? Now come to the Modigliani and Miller approach. According to this approach, under the condition of perfect capital market, rational investors, absence of taxes, discrimination between dividend income and capital appreciation, the dividend policy of any firm may no have no any effect on the value of firm. So this approach also says that under the condition when the buyers and sellers are many, which is a perfect capital market, they are rational investors, there are taxes absence, there is a difference between the dividend income and the capital appreciation. The dividend policy cannot affect also in those conditions. So there are some arguments of Modigliani and Miller approach that are whatever increase in the value of firms results from the payment of dividend will be exactly offset by the decline of the market price of shares because of external financing. So when companies pay out the dividend from the profit, it may increase the value of firm, but for the future expansion, when they have less money, they will have to go for external financing, which will automatically decrease their market price of share. So there will be no change in the wealth of shareholders due to dividend policy. So whatever a shareholders gains on the account of dividend payment is completely nullified by the fall in the market price of shares due to decrease in the expected future earning per share. So in financial term, if we talk totally specific, then the market price of share in the beginning is equal to the present value of dividend paid at the end of the year, or the cost of capital at the end of the period, right? Now come to the criticism points of M&M. Firstly, they think that there is a perfect market, which is not necessary. Second thing is they think that they know everything, every information about the company. Taxes do exist, and there is a difference between tax treatment for the capital gain and the dividend. Firms doesn't follow a rigid investment policy. Preference given to the current income as compared to the future income, and firm okay preference. So this is about the criticism of M&M. Now come to the theory of relevance. So theory of relevance comprises of two approaches, that is Volter approach and Jordan approach. In Volter approach, if R is greater than K, so firstly I will tell you what is R. R here is internal rate of return and K here is cost of capital. So if internal rate of return is greater than the cost of capital, then firm should retain their earnings, because their return amount is internal rate of return amount is higher, then they should return the earnings, because these firms are known as the growth oriented firms. And if the and here optimum layout ratio payout ratio is 0. So if R is greater than K, then the increase in dividend layout, the value of firm also decreases. And if we talk about the decrease in dividend layout payout, the value of firm increases, right? So if a firm if the rate of return is greater than the cost of capital, then the value of firm then the firm should retain their earning, because such firms are known as the growth oriented firms. So in that case, the when we talk about the increase in dividend payout, that will be there the value firm decreases. But if we talk about the decrease in dividend payout, there the value firm increases. So in second case, when the internal rate of return is less than the cost of capital, in that case, if we talk about in that case, firstly company should give dividend to the shareholders and retain less money. So in that case, increase in dividend, in the case of increase in dividend layout, value of firm will increase, and in the case of decrease in dividend layout, value of firm will decrease. So if we talk about the R is equal to K, that the rate of return is equal to the cost of capital, then there will be no change in increase in dividend and no change in decrease in dividend. So this was about the Volter approach. Now come to the assumptions of Volter approach. In the assumptions of Volter approach, the first assumption is that the investment of funds are financed to retain earnings only, and firm will not use external financing, which is not possible. Firms cannot always run the business from their return earnings. They have to go for external financing. And the R and K factors are constant. R here is internal rate of return, K is for cost and capital are constant. Earning and dividend do not change while determining the value of firm. The firm has a very long life. And if you talk about the price of share, the price of share will be calculated by the dividend divided by 1 minus cost of equity. And when we assume there is a growth, then the formula will be price is equal to dividend by cost of capital minus growth, right? So these are about the assumptions of Volter model. Now come to the criticism of Volter model. The first criticism is that it is not possible to raise the funds from finance from the internal source only. And the second one is the IRR is not constant and K also change according to the situations. So these were about the criticism of Volter model. Now come to the Jordan approach. In Jordan approach, if R is greater than K, then the price per share increases as the dividend payout ratio decreases. At that time, the growth firm should distribute the smaller dividend to the shareholders and retain the maximum earnings, because these are the growth oriented firms which we discuss in the Volter models. When the R is equal to K, R is greater than K, right? Those firms are growth oriented firms. So in the Jordan approach, what they say is that the growth firm should distribute less dividend to the shareholders and retain the most amount to the earning. If R is equal to K, the price for per share remain unchanged, as it is not affected by the dividend policy. If R is less than K, the price per share increases and the dividend payout ratio increases. Assumptions of Jordan approach. There are some assumptions that the firm is all equity firm and there is no external financing, R is constant, growth rate is constant, KO cost of capital is constant, firm has low perpetual life, which is not possible every time, government tax doesn't exist. So these are the assumptions of Jordan approach. So now come to the factors affecting dividend policy. The first factor affecting is the legal factors. While declaring the dividend, the board of directors will have to consider the legal restriction. The about the Indian Companies Act, it prescribes the certain guidelines in respect of declaration and payment of dividends, and they are to be strictly observed by the company for declaring the dividends. So the next point is the magnitude and the type of earnings. So the stability of earning is one of the most important factors influencing the trend of earning or the influencing the dividend policy. If the earnings are relatively stable, a firm is in a better position to predict what its future earning will be, and such companies are more likely to pay a high percentage of earnings in dividend than the companies who has a fluctuating earnings. Third one is the desire and types of shareholders. So if your investors are of weaker section, they are not so much rich, then the company should give them regular dividend, right? And if the investors are rich, and so they should avoid taxes and preference to the give preference to the future capital gain. Third one is the nature of industry. If the company is stable, uh, then they should give regular dividend. If the company is not stable, they can't give them the regular dividend. Age of industry, if company is an old firm, then the dividend will be higher. If the company is a new startup, they can't give you regular dividend and high also. Economic policy, oh, sorry, age of industry. So we have done the age of industry, sorry. Now come to the economic policy. If you talk about the Chinese economy or other countries economy, they give more dividend as compared to India economy. Future financial requirement, what are the financial requirements of the company in the future that can also affect the dividend policy of the shareholders in the present. So these are about the factors affecting dividend policy. So we have covered its meaning, types, theories, and factors affecting dividend policy in financial management. So I hope you have liked the video. If you like it, make sure you like, comment your query if you have, and share this to your friends. And if you have not subscribed our channel yet, make sure to subscribe and turn on the bell icon, so in future if you upload any video regarding financial management or any other management subject, you will be notified. Thank you very much.